Happy Tuesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. Let's jump in. And we begin as we usually do in North America. U.S. Secretary of Health and Human Services Robert F. Kennedy Jr. has vowed to fight a health crusade. At the core of Kennedy's agenda is a sweeping attack on the $2.4 trillion U.S. food industry. By targeting sugar, ultra-processed foods, and artificial additives, elements he blames for America's chronic disease crisis, Kennedy's policies risk disrupting a deeply entrenched system. His path to upgrade the U.S. National Dietary Guidelines by autumn 2025 with strict limits on added sugars and aggressive reductions on synthetic dyes and additives could reshape supply chains, product formulations, consumer habits, and, if successful, the average American diet. For major food and beverage companies, these proposals represent a looming regulatory and economic challenge. Companies like PepsiCo, Nestle, and General Mills face pressure to reformulate flagship products, a process that entails both direct costs and potential market risks. For example, PepsiCo's announcement that Lay's crisps will be dye-free by year-end hints at the scale of reformulation underway. However, eliminating dyes from iconic products like Cheetos and Doritos could unsettle brand loyalty and erode market share. A particular flashpoint is Kennedy's support for restricting purchases of sugary drinks and snacks with Federal Food Assistance SNAP benefits. SNAP, SNAP's annual $100 billion budget supports over 41 million Americans, and an estimated 20% of those funds go to sugary and processed foods. If federal waivers, like those granted to Nebraska, Indiana, and Iowa, expand to other states, the reduction in sales volume could dent the revenue streams of beverage and snack makers. Meanwhile, Kennedy's Make America Healthy Again Commission is leveraging bipartisan support to push reforms traditionally championed by left-leaning states into Republican strongholds. The rise of the so-called MAHA, Make America Healthy Again movement, comprising influencers, wellness advocates, and political allies, has accelerated this trend, threatening the industry's ability to count on conservative lawmakers for protection. This political realignment could lead to more states enacting bans on certain food additives, as seen in West Virginia and Arizona, amplifying operational and compliance costs for manufacturers. From an economic perspective, the policy shifts risk destabilizing food industry profitability, prompting an increase in R&D spending to develop compliant products. Additionally, smaller players and suppliers, particularly those dependent on synthetic ingredients, face the prospect of declining demand and heightened regulatory hurdles. These changes could also result in improvements, modest or better, to Americans' diets and health, which most would agree is a positive outcome. And indeed, Bernstein analyst Alexia Howard points that this regulatory-driven shift toward clean-label products could ultimately rebuild consumer trust and spur demand for healthier processed foods. In the long term, the industry may benefit from premium pricing for reformulated goods and a more resilient market position. Yet this transition could be uneven. Lobbyists are fighting back against what they see as heavy-handed government overreach. Concerns about the scientific rigor underpinning Kennedy's policies raise the risk of legal challenges, regulatory reversals, or market uncertainty. Moreover, if his initiatives, such as the proposed dye bans, are implemented too harshly, they could disrupt production cycles, increase costs, and impact pricing for consumers. In the broader economy, the changes may spur shifts in agricultural demand as food processors pivot from conventional ingredients to natural alternatives. This transition could benefit sectors like natural colorants, plant-based sweeteners, and organic farming, while squeezing traditional suppliers of synthetic additives and sugar. For policymakers and investors, the stakes are high. Kennedy's aggressive reform agenda could reshape not only American diets, but also the contours of the food economy, prompting businesses to recalibrate strategies in the face of a shifting regulatory landscape. As the administration signals that, quote, "this is just the beginning," end quote, the coming years may mark a turbulent yet transformative period for the U.S. food industry. If you're getting some value from today's episode of Market Update and you'd like to continue to be on top of the most up-to-date analysis on the biggest developments in markets around the world, consider subscribing to Market Update, hit the bell notification icon, and you will be. And if you're enjoying today's episode, don't forget to hit the like button. Next up, Indonesian President Prabowo Subianto's ambitious spending plans face growing headwinds as global market turmoil and the US trade tensions threaten to derail the fiscal trajectory. While Indonesia's fiscal fundamentals remain sound, experts caution that external pressures could force the government to scale back expenditures or ramp up borrowing. The recent US-China trade truce offered some breathing room, with Jakarta expressing optimism about securing its own agreement. However, uncertainty lingers. US President Donald Trump's inflationary trade policies have shaken global bond markets, with Moody's downgrading US sovereign debt, citing mounting debt and interest costs. Across Asia, investors remain cautious, pushing up yields and prompting reassessment risk. Indonesia's fiscal strategy has already unnerved investors. In February, the president announced abrupt budget cuts of the equivalent of $19 billion, slashing infrastructure funding to make way for his flagship free school meals program and the new sovereign wealth fund. The move triggered foreign investor exits, leading to market turbulence and brief trading halts in March and April. Despite this, Jakarta has maintained a bullish stance. Deputy Finance Minister Ibi Manyu downplayed the trade war's impact, citing Indonesia's high domestic bond ownership, robust foreign exchange reserves, and limited US export exposure. Yet tax revenues fell 12.18% and non-tax revenues slumped 26.03% year-on-year in Q1, exacerbated by a botched VAT, value-added tax reform, and sliding commodity prices. Market reaction has been mixed. Yields on Indonesia's 10-year bonds rose 27 basis points to 6.92 between the president's inauguration and Trump's tariff threats, though they have since stabilized. Analysts warn of limited fiscal space too, with budget deficits capped at 3% of GDP and $50 billion in bonds maturing this year. While Indonesia enjoys relatively high real yields and a stable currency, sustained global volatility could undermine the president's growth targets. The World Bank and IMF both forecast Indonesia's GDP growth at 4.7% for 2025, well below the president's ambitious 8% target. Compounding the challenge, further debt issuance, especially if tied to SOEs, could mirror past policies that left state firms burdened with unsustainable debt. As Rohit Garg of Citi notes, Indonesia's market resilience hinges on credible fiscal management. Quote, "The government will need to provide clarity around its medium-term fiscal framework," end quote, he said. For now, Indonesia's macro stability offers some insulation, but without decisive action, the risks to the president's agenda are mounting. And it is not just developing nations feeling the pain from the global bond sell-off or fiscal pressures, it has also intensified pressure on UK Chancellor Rachel Reeves and her fiscal strategy. Gilt yields surged last week, with 30-year yields closing at 5.48%, near a 27-year high. Meanwhile, UK 10-year yields have risen more sharply than those of any G7 country except Japan over the past year. The market's turbulence is challenging Reeves' commitment to balancing day-to-day spending with revenue by 2029 through 30, amid sluggish UK economic growth and rising borrowing costs. Prime Minister Sir Keir Starmer's recent proposals, including reversing £1.5 billion in pension savings cuts and potentially ending the two-child benefit cap at a cost of £3.5 billion annually, further strain the government's fiscal headroom. Global events are adding fuel to the fire. As we explored last week, US Treasuries have sold off, while Germany's yields have climbed following a landmark deal to fund military and infrastructure investments, something we covered several weeks ago. The UK's tight correlation to these markets has exposed it to heightened volatility, compounded by domestic challenges like stubborn inflation and a divided Bank of England. Analysts warn that Reeves' limited £9.9 billion of headroom leaves little margin for error. A BNP Paribas note yesterday cautioned that markets are watching for fiscal vulnerabilities, placing the UK in a dangerous position. Quote, "At times like this, markets tend to look for the outliers, places where things could go wrong fiscally, and unfortunately the UK finds itself in this category." End quote, it said. Some caution against loosening Reeves' rules, warning of a potential market tantrum, reminiscent of Liz Truss's mini-budget debacle in 2022. Others suggest further tightening may be needed this autumn. Adding to the uncertainty, the Office for Budget Responsibility may revise its optimistic long-term growth forecasts, which could slash Reeves's already narrow fiscal space. Ruth Gregory of Capital Economics estimates that a productivity forecast downgrade could reduce headroom by £20 billion. It seems that the UK's fiscal and economic pain for the foreseeable future is only set to intensify. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Tuesday, and I will see you for another episode tomorrow.